With unallocated silver, you may think you have silver, but actually all you have is, if you like, you're a creditor of whoever is offering the allocated service. You don't own anything at all. You don't even have an entitlement to any silver. You're just a creditor, and the value, if you like, of the provider's debt to you is obviously tied to the silver price. But if they go bust, you go whistle. It's as simple as that. There are then two further forms. You've got, I think, what you call pool allocated, and that's the sort of thing which GoldMoney does. And that would be useful, and I think almost the most sensible way to go. If you have a few $1 million worth of silver, you don't want to keep it all in your home. But if you've got lots and lots of silver, then a pool allocated in an LBMA member vault, fully insured and all the rest of it, does make an awful lot of sense. I make this accusation only in the knowledge of people that I've known who have gone to collect their gold from, say, banks in Europe, to find that they have a hell of a problem getting the gold out of them. And it's not just banks. I mean, Germany had a hell of a problem getting gold out of the out of the New York Fed. So you can see that this is, when it comes to precious metals, the best thing to do, I think, is really to trust no one. Now, if you're a speculator, then it really doesn't matter. I mean, all you're interested in is the price. So if you're a speculator, that's probably where things like ETFs might come in, because ETFs, again, you have absolutely no entitlement to the underlying silver. All you have is a share in a trust or a fund, as it were, and through that, on liquidation, you will have some claim over the assets of the fund. And hopefully the fund has complied with its prospectus, and if it says it's fully backed by silver, then on liquidation, probably what would happen is that the silver will be sold and money would be passed to you. Well, I don't make forecasts. I mean, there is no reason why silver should go any lower, other than manipulation by the bullion banks. But I think that, bullion banks basically are running scared. They can't close their short positions in gold, which amount, on my calculations, to around about, I think, $35 billion between about 30 of them. I mean, this is serious stuff. If you've got an average loss on your books of about which sort of coming up to a reasonable fraction of that, assuming that you went short at a level and you're short of $1 billion worth, and you're probably losing, I don't know, sort of 100 or 200 million on it. I mean, this is serious stuff, and it's the only thing you can do is try and job your way out of it. So you let the price rise a bit, and then you bang it, take out the stops and all the rest, all that sort of stuff. So apart from that, it is absolutely clear to me that on any long-term basis, given the massive quantity of dollars and bank credit that have been printed, certainly since the Lehman crisis, gold and silver are as cheap as they ever have been. There will come a point where broken markets begin to fix themselves, because markets always win out in the end. I mean, central banks can suppress this, suppress that. Big banks can do this, push the price down, push the price up, whatever they want to do. But at the end of the day, and it may be sometime in the future, but at the end of the day, markets always return, if you like. Pricing comes back. Pricing gives you the right economic signals. We're not getting the right economic signals at all at the moment because of the suppression of interest rates. The amount of money that's being literally hosed into financial markets, I mean, 120 billion a month going in from the Fed. into pension funds and insurance companies in the form of QE. I mean, this is just massive. This is just market rigging, complete market rigging. The markets are fundamentally broken. And part of that is the suppression of precious metals so that they don't indicate that markets are broken. That is going to change. We don't know when. We don't know what event is going to suddenly switch flick a switch, but it will happen. And then you will see that I think precious metals will be on a completely different price level. Now, when that happens, you're either in or you're out, because just imagine that we're moving towards that $50 price level for silver that you mentioned. We wake up one morning and find that suddenly it's $35 bid. What are you going to do? Are you going to panic in? Or are you going to say, hold on a minute, I think it's going to, don't rush. Let's just let it settle down, and then we will look at a level to buy some. But it doesn't settle down. It's 40 bid. What are you going to do now? This is what I tell everybody. I mean, if you believe my story that fiat currencies are extremely dangerous and in danger of collapsing along with financial markets because markets are broken, then you must have some insurance against that event. And that insurance is physical ownership of some gold and some silver. I mean, it's as simple as that. Bitcoin isn't going to save you under these circumstances at all. Because just think, I mean, people talk about Bitcoin being the money of the future, but just imagine a bond market running in Bitcoin. You'd have to have deeply negative interest rates because the supply is capped at 22 million, whereas, the global economy evolves, if you like, and, people's standard of living tends to improve. That's not going to happen with Bitcoin. So you can see that if demand for gold goes up because economies demand it, the private sector demands more money, if you like, then it's there in the form of scrap. It migrates from use as jewelry or whatever into a monetary use. And this is desperately important. You've got to have the flexibility, but the flexibility is with the people, not with governments. That is the key. That is the key to understanding it. And silver is very, very much part of that story. It really is. People who invest in silver, just the same as they invest in mines or pharmaceutical companies or whatever, it's part of a portfolio. Now, in that sense, you're measuring the performance in fiat currency. So, in Australia, it would be Australian dollars. And you don't actually sort of care. You're not going to be taking delivery or worrying about the security of it beyond counterparty risk, maybe. But that's it. And you're going to be taking profits. You're going to sell it eventually.